My name is Sol Waksman. I'm the president and founder of BarclayHedge. Our firm has been in business for the last 25 years, and we collect data on the performance of commodity funds, currency funds, and hedge funds, compile it into databases, make that data available to banks and brokerage companies. If you look at managed futures from, let's say, 30,000 feet, we'll see that the two main classes are what could be described as systematic traders, those that are using either a computerized approach to trading or something that is very much rules-based. The opposite of a systematic trader would be a trader that relies on their judgment and experience. Within the industry, we call that discretionary trading. If you look at the breakdown within the industry, approximately 60% of traders employ a systematic or what could be called a trend-following approach. Approximately 20% employ a judgmental or discretionary approach, and the remaining 20% are some hybrid of the two approaches. What we find is that the CTAs are using almost all of the CME products. The hedge funds as well use CME products such as currency futures, interest rate futures, and stock index futures, both for directional exposure and for hedging. Typically, managed futures, or CTAs, have what's called a neutral correlation to stocks. By neutral, what we mean is that you cannot predict the performance of one class by the performance of the other class. So if stocks go down, managed futures can go up, it can go down, or it can be neutral. The fact that it is neutrally correlated has tremendous benefits for a portfolio, in that by combining asset classes that aren't correlated with each other, the portfolio as a whole, the level of volatility of the portfolio as a whole decreases while potentially return increases. Well, I'd say one of the most common misconceptions about managed futures is that people believe they are investing in commodities. The futures markets, while historically started out as commodity markets, they now include financial futures. So most large CTAs, in addition to trading the major commodity markets, are also trading interest rates, they're trading stock markets, and they are trading currencies. There are several differences between active and passive management. Passive management, for the most part, implies being long only. In my opinion, there is no inherent reason why being long only is a superior investment approach to being long and short. For years and years, the case was made that if you invest in the stock market, that there is an inherent return that comes from being long stocks. Well, if you've been long stocks for the past 10 years and you're making any money, you're probably in the minority. That if you look at commodity prices, cotton was more expensive in the Civil War than it is now. There is no inherent reason why prices in commodity markets or in equity markets should go up indefinitely. Alternative investments give one the opportunity to profit from markets that are going up as well as from markets that are going down. One thing that I've always noticed about managed futures versus hedge funds, for example, or stock investors, is that When we look at approaches that managed futures advisors or CTAs utilize, they're sometimes categorized as black box approaches. And in spite of the fact that we have history going back from since 1980 till now to show that these types of approaches are profitable, that when the inevitable losing periods come along, investors tend to lose confidence. Managers that are using black box type of approaches go through their inevitable losing periods. Investors tend to come to conclusion that the system that the manager is using is no longer working. However, when that same investor is invested in stocks and stocks go through their inevitable losing period, that investor does not say, oh, the stock market is no longer working. I think it's harder to get comfortable with a black box type of approach, even though those approaches have very long histories of being profitable. And I think this is one of the issues that institutional investors and pension funds need to get comfortable with. I would say after my more than 2 decades of experience in this area, the 2 main points that I take from it is, number one, I do not see a reason to invest in something that is long only. That I believe that at different times prices go up as well as go down. Managed futures is an area where you can be long, you can be short, and it's just as easy for a manager to go long or short. I like that. I think it's a tremendous benefit for the investor. The second point is be honest with yourself about your pain threshold. How much of a drawdown can you sit through without having to panic and redeem your investment? Know your pain threshold and go with it.